as the year began, my feeling was that the U.S. economy was in a unusually strong position. First, we had seen a significant resilience of the economy in the previous few years in the face of this very aggressive central bank hiking cycle, the 525 basis points of hikes from Jay Powell. But in addition, there were some really important structural developments. The U.S. economy had significantly outperformed the rest of the world, at least other DMs, over the last few years. We're seeing evidence of ongoing reshoring. The U.S. was benefiting from having a cheap and stable energy supply. The U.S. looked to be the center of the digital AI tech revolution, and that was attracting a lot of investment. And maybe one summary statistic for all of this is the U.S. had seen its share of global foreign direct investment, or FDI, increase significantly. Now, of course, there were some question marks about the path of inflation, and the Fed had begun a cutting cycle, but how far they could go remained an open issue. But broadly speaking, I think it was a very favorable outlook. And you mentioned productivity specifically. At a minimum, productivity was back to kind of where you'd think it should be based on a 10-year kind of trend. And arguably, and these debates were being had, arguably maybe had pivoted up a little bit as well.
Just to push on the vulnerabilities, the argument that inflation hadn't landed, so the Fed doesn't have much room to cut rates at the sign of nervousness about the economy, that consumer spending was running through people's savings, increasing borrowing, and that the stock market was, in some sort of bubble. Those vulnerabilities.
So I'll take them in opposite order, the way you stated them. For the equity market, I very much agree that as we entered the year, I think stocks were priced, if not for perfection, they were priced for something that was approximating it. But I don't think I would use the word bubble or necessarily mispricing. But I think those values reflected, one, the ongoing meaningful growth of earnings of U.S. firms. It was some of the bullishness that I described on macro performance. And it also very much reflected a view that the U.S. would be, if not the only country to benefit from AI, at least a central beneficiary of AI. But I think in each of those cases, there was an open debate about whether they were too optimistic or not. On the consumer, upper income consumers clearly were in a strong position. Lower income consumers were showing more of a pinch. But broadly, as long as the labor market continued to function, it seemed like those lower income consumers would continue to be paid and continue to spend. So the labor market was the key, and it looked all right. And then finally, for inflation, that was obviously something we needed to watch closely. But I was reasonably comfortable that shelter inflation that had been very elevated was in the process of coming down, and not as comfortable, but at least hopeful that we'd also see non-shelter inflation come up. One final point, another vulnerability that you didn't mention that I want to emphasize was true going into the year and remains true, is on the fiscal side and the size of the budget deficits and the debt, and what that means for Treasury issuance in the years ahead.